going to be talking about receipts and tax management, which kind of go hand in hand because ultimately you need your receipts so that way you can have your records to be able to do your taxes. The objectives for today is to know what records to keep, how to keep them, and for how long. Okay. To know what to keep, you have to know what the IRS's definition of a business expense is, which is an expense must be both ordinary and necessary to be deductible. Ordinary's definition is an expense that is common and accepted in your field of business or trade. Necessary is an expense that is helpful and appropriate for your type of business. Sometimes there's those borderline expenses because the necessary expense, anybody can spin an expense to make it fit into that category. So deep down, you all know, if you're trying to spin something and if it's believable or not, is it really worth it to try to get that certain expense where an auditor can come back and say, no, I don't think so. So if anything is borderline, always write on it what that expense was for. Okay? Write directly onto the receipt. Ultimately, your goal is to have an accurate tax return. And the first step to accuracy is to separate your business from your personal. A lot of you know that already. I have plenty of clients that I tell that to, and they're like, yeah, I know. But do you really know what the cost of it, of not separating your expenses are, or why you really should? Corporations are required, basically by the IRS. Sole proprietors, you're not required, but I strongly recommend and suggest that you do separate your business from your personal. Also, if you don't separate it, you're going to have a harder time, and it's going to be very time consuming to go through your bank statements and all your receipts and credit card statements, highlight all your business expenses to try to come up with the figures that you need for your tax return. If you incorporate, okay, ultimately when you incorporate, it's to limit your liability. So if you do get sued from a business aspect, they're not going to dip into your personal assets. But if you're commingling your accounts and your business expenses and personal expenses, you just open your personal side up to that lawsuit. Okay? So ultimately, by incorporating and commingling, you fail to really protect yourself. The other big reason, and that's really the number one reason, is because of audits. Whether it's from the IRS or a CPA to get an independent CPA audit. A lot of you might be thinking, I'm a small business, I'll never need a CPA to audit my books, but you just never know. Ultimately, you want to grow. And sometimes banks, if you want to get a loan, they require you to get audited financials. I think North Carolina, if you're a contractor and you're trying to get a business license in North Carolina, they require you to have audited financial statements. So you just never know. So you want to separate it because when you do find yourself in an audit, if the stuff is commingled, then the auditor is going to be very skeptical of everything that you tell them. They're going to be looking at your stuff going, okay. Or they're not going to trust what you say. The two examples, iTunes, for example, that's an ordinary expense for a fitness center or a dance studio. Okay? Redbox can be an ordinary expense for the fitness center. So if an auditor is auditing the fitness center, let's say, and he sees these, and the stuff is separated, he's just going to keep on going. If the stuff is commingled and he sees these two items, then he's going to be like, is it really a business expense? That's where the skepticism is going to come in. Or that day they decided to just go to the Redbox and just run the movie and take it home. So you put that doubt in the auditor's head, and you really don't want that. Okay? On the other hand, for me, those are not ordinary business expenses, but they may be necessary. For example, what if for the slideshow, there was a part of a song that I wanted to stick on here, and I downloaded a song from iTunes. Okay, now when I do that, I would write on there, downloaded such and such a song for such and such presentation. Okay? And when I get audited, if he comes by that receipt and he sees it, whether it's commingled or not, he sees it. He sees that I took the time to write it, and then he'd be like, okay, no problem. Now, if I don't write on the receipt, he's going to ask me a question. What's this item? And if I tell him and explain to him, he'll be like, okay, you know, that's a good reason for having that kind of expense. But if my stuff is commingled, he's going to still have that down in his head. Okay? So that's why separating is really like the very most important thing that you do. Okay, next step is to look at your tax return. Okay, your tax return will tell you the categories that you need to separate your expenses in. Schedule C is for the sole proprietors and the one-person LLCs. I just have the 1120S on here, but if that's for the subchapter S corporations. But if you are a C Corp, it's just 1120, and if you're a partner, it's in 1065. But it's pretty much about the same. So just look at the tax returns, the front pages, and I'll tell you the categories. Now, this is something that I couldn't find really anywhere but on my tax software. And I couldn't even print this page. I had to take a screenshot of it and put it in Word and print it out for you guys. And that's in the handout. So these are the other categories that when I'm doing a tax return, I slip the figures into. So this is another thing that you want to keep in mind while you're categorizing your expenses.
This is on Schedule C? I'm sorry.
No. But that's just what I suggest that you categorize expenses as. Okay. You can be a little bit more flexible with Schedule C. Okay. The only thing that I suggest is with these expenses, the more you have categories, as far as these are concerned, the less you're more likely to get flagged by a computer system. Because if you have a huge expense in a certain area, and the IRS's computer system says, okay, if this expense is over X percent of their income, flag it. And then they send that tax return to somebody to look at it. And that person might look at it and go, okay, you know, everything goes fine, and it goes forward. But that's why you really want to categorize stuff as much as you can. Okay. So then on top of these categories, really think about it and choose category that what you really want to look at. For example, I think I've mentioned it before for myself, I have a tax prep expense because I want to know how much it's costing me to prepare taxes. And in that category, I put my software, I put my insurance. If I have to pay extra for a form, whatever it is, I stick it in it. Okay? The next step is set up a system of record keeping and really, really think about it and plan. The planning stage is what do you want out of it? How can you keep track of it? I can tell you to do this, this, and this, and this, but in all actuality, are you going to do it? So find a way of something that you will actually do. That's your ultimate goal in record keeping, is to find your receipt, okay? And then down here, I don't know if you can see, it says, in a timely manner. Because if you are being audited, okay, and the auditor says, hey, what's this expense? And you go up and like, boom, there it is, here you go. He's going to be like, okay. But if you're like, dang, where did I put that thing? Then the doubt comes back in. Okay? These are your source or supporting documents that any auditor would be looking at. Your income would be any of your sales invoices, your register tapes that you give out, bank deposit slips. Your expenses are your purchase invoices, receipts, check stubs, and canceled checks. And of course, bank statements, credit card statements, and any loan agreements, whether it's loans you give out or loans that you have. This is, deposits are not always income, okay? And if you're not organized, you're gonna end up paying taxes on something that you don't have to pay taxes on, okay? So the only thing that's taxable is your sales and services and the interest and the dividends. Capital gain, that's if you sell a business asset, it might be a capital loss, okay? But either way, the money that you make from selling that asset, you're gonna put it in the bank eventually. And if you go just by the deposits, you're gonna be paying taxes, even if it's a loss, on those capital gains. And then capital gains are taxed at a lesser tax rate than your regular income, okay? And this is what the big deal was during the election. Everybody was saying Mitt Romney was paying less taxes than us. That's because he had capital gains more than he had income, so he paid less taxes. And then you have the non-taxable deposits, which is donations if you're a nonprofit, loans that you got from the bank that you deposited into your account, loans from family, money that you've personally put into the bank account, and any refunds that you've gotten back from a vendor. Outflows. Outflows. Payments do not always equal expenses, and expenses does not really mean that you actually spend money. So your expenses are your regular business expenses that we talked about earlier. And I want to touch base on meal and entertainment because that's a biggie. Basically, if we have a one-on-one and we go have a bite to eat, that's a business expense. If we have a one-on-one and we go out and all we talk about is family, that's not a business expense, okay? That's personal. So anytime that you have a meal or an entertainment, write on that receipt. Had a such and such meeting with so-and-so, and we talked about such and such. You have to talk about business at that meal. Okay. Payments that don't equal expenses are your assets, inventory, major repairs, owner's draw. This is different than actual commingling. This is just you writing yourself a check. It's not you going to Food Lion or Farm Fresh and swiping the business card. Okay? You're actually writing yourself a check that you just didn't pay taxes on. Okay? Loans that you make to others and refunds. This is also the reason why on your financial statements, net income is not always what's in the bank. Okay? Because you have all these payments that do not equal expenses, so they don't show up on your profit and loss. Okay, and then you have the expenses that are not cash. These are the depreciation, which is the assets that you purchase that you depreciate. Okay, and basically you need to keep a record of those. You need to keep the date that you purchased, how much you purchased it for, and what it was. And then that way when you sell it, you need to keep records of the date that you sold it, any major repairs that extended the life. So if you have a new transmission put into your car or a new engine, that extends the life of that car, vehicle, so it becomes out of life, so you depreciate that along with the asset. And then of course the sale price. Okay? And the other big thing is mileage. Okay? Everybody in here has mileage because your commuting doesn't count. So when you came from here today, from your house, okay, that doesn't count. But when you leave here and walk out those doors, you could go to your office, you can go anywhere, you can go client. All those are business miles. So all of you have that expense. And to keep a log of it, there's an app for it. What I do personally, basically you just have to have a log. What I do is I take a check register and you put the date, start, end, and the reason for why it's a business. And then I put the mileage that it took from here to here, and then in the far right, I keep a tally along for the whole year. Okay. Okay. Next step is to set up a system of filing. If you don't have software, you're going to be restricted about what you can do to file. Because usually if you have software, you look up in the software system, okay, I bought it in March. And then you can actually have a month where all your month expenses are, and you can easily find it. But if you don't have software, you can't have a folder that just says March on it. Because then if you're trying to find a receipt, you're like, okay, I think I bought it in March. You go through to March, oh no, well maybe it was February, but no. Oh, okay, maybe April. It gets time consuming trying to find it. So what I do at the end of the year, if I get somebody that gives me a box of receipts for taxes, I separate those receipts and tally them by the classification, by the expense type, and then I take the calculator tape and I staple it to the receipts and then write on there X amount, whatever it was, that expense. Okay? And then that's their form of record keeping for tax purposes. For tax purposes, it's great, it's awesome, because if you ever get audited by the IRS, they say, well, what's this expense? You just hand them that calculator tape. I say, here you go. And then all they have to do is just compare the figures from the calculator tape to the receipt and actually look at the receipts. Okay, yes, it's an expense, yeah. Okay. For a CPA audit, it's not that great. It's kind of complicated things because the CPA compares the bank statements and credit card statements to those receipts. Okay. But if that's all you do, at least that's the minimum, and that's good. Okay. Also, you could throughout the year you could have envelopes and you could stick the receipts in the envelopes too, and then at the end of the year go through and tally it up. What I do if you don't have that many expenses in a month is I attach everything to the bank statements and credit card statements. Okay? Because first of all, if you have all your receipts and everything behind your credit card statement, you have a summary of the transactions in the front. So if you're looking for a certain receipt, you just look at the bank statements or the credit card statements, and you're like, okay. And then the other thing I like to do is I put them in the same order behind it as they show up on the statement. Okay? And of course, staple it. Even if you have to buy a big, heavy-duty stapler, staple it, because those receipts will fly off, they'll go everywhere. So invest in a heavy-duty stapler and make sure you staple it. Don't just clip it. And then after you attach all the receipts to the statement, you can go through month by month, either with a separate sheet or a white space on the statement, and then you can go through it and categorize each statement. So you have your advertising expense is X amount for this statement, your office supplies is X amount. And that way, at the end of the year, you just have 10 figures or 12 figures to tally up for each expense, and then there you have it for your tax return. That's the best way. Okay? Whether you do it or not, at least do this. But this is a little bit more time consuming. But that is the best way for both the tax audit and a CPA audit, because everything is right there for both. Now, if you have software, or if you have a bigger company, more transactions, you can keep your records a different way. Basically, take your cash register tape, the copy of your stubs, payment stubs. These are inflows, okay? So this is income. Your invoices, and you attach them to the deposit slip, okay? And then you file it away in a folder called deposits. Okay? If you paid it, or if you got paid by a credit card, you take that invoices, attach it to the credit card slip, and then once your merchant services statement comes in, you reconcile those slips to those services, the merchant services statement, and then you keep them all together and stick them in a folder called bank name, whatever the bank name is, or you can stick them in with the deposits. It's up to you. Okay. 1099s, that's the 1099s that are issued to you. Okay. These are important for you to keep, because if those 1099s add up to more what your gross income is, then you're going to get a letter from the IRS saying, it doesn't match, you owe this much, because that's how much we show you as income. But most of us, when we get 1099s, it's a lot less than what our actual gross is, because not everybody issues you that should issue you a 1099 issues you a 1099. Loan agreements, any loan agreements that you give to anybody, any employees or anything like that, keep those in a separate folder by themselves so that way it's easy access with the name of the loan and the loan number. Okay, these are your expenses, these are your outflows. Okay, invoices that you pay, attach check stub to it. If you don't print your check stubs or don't print checks, you could just write check number such and such on the invoice itself. Anything that marks it as being paid. Okay, and then you can file it under the vendor name in a folder ABC, or only if you have checks software do you do it in check number order, because you can actually look at the software and say, okay, it was check such and such, and you can find it easily. If you don't have software, you're not going to be able to find it when it's in check number order. Credit cards, if you pay something by a credit card, like I said before, same with the non-software, you attach it to the credit card statement. Or a debit card, you attach it to the bank card statement. And then you file them under the bank name. And if you have more than one account with the same bank, put dash in the last four of the number so that way you can easily find it as well. If you do have petty cash, keep those separated in a separate folder called petty cash. Furniture and equipment, anything that is an asset that is still being depreciated, keep it in a separate folder by itself, because you need that for the tangible property tax for the city as well. And so that way it's easy access. If you sell it, you can easily go back to it, pull it out, and know exactly how much you paid for it. Any loans that you have outstanding should be in a separate folder by itself. So if you ever need to refer to loan terms or anything like that, you have access to it right away. Records to keep for your employees. Basically everything that you have an employee sign, you give to an employee, goes in that employee's name folder. I-9s are so important, okay, especially nowadays. The I-9s keep in a separate folder, and that's if you hire somebody, you get them to fill out an I-9. Basically, that's you proving that you did your due diligence to make sure that that person is allowed to work in the U.S. Okay? Because with the I-9, you're going to get a copy of their Social Security card, their driver's license, or anything else. There's a list of things that is acceptable by Homeland Security. Okay? They don't expect you to know what a fraudulent Social Security card looks like, or a driver's license, fraudulent driver's license looks like. But if they ever come back to you and you show them that you did check, then you did your due diligence and you won't get in trouble. And the quarterly returns should be set aside by themselves, and attached to those quarterly returns, of course, is the report that supports the figures. The timesheets should be attached to the pay stub, and they should be in a folder by themselves by pay period. Oh, you guys were here, it wasn't loud enough. It was a wacky laugh. That's the cost of being organized, unorganized. It's your sanity, okay? And of course, dollars, your money. Because then you're going to be paying late fees, you're going to be paying finance charges, penalties, and interest. You're going to forget to take some deductions. You're going to forget that maybe you even have some receivables coming to you. And of course, you may double pay an invoice. Sales tax on credit card purchases. The state does sales tax audits. And they will come through and look at your bank statements and your credit card statements and any purchases that you make online. And if you don't have a receipt proving that you paid taxes on it, that you will get paid. You will have to pay sales tax on it, whether you pay for it or not. So that's why you really need those receipts attached. And of course, your time. Okay. And the rest of the steps to accuracy is to constantly update your records, reconcile your statements, and regularly review your financial statements. The rest of these slides is the other handout that I handed out to you guys, and that has how long you should keep your records for. There's 3 years, 7 years, life plus 7, and permanently. Okay. So, and those you can look at. There is one error here that I noticed after I printed them out. Under the life plus 7, cross out the board meeting announcements. That's permanent. That's under the permanent records. And that is it. Ask any questions?
On the mileage, is it too late to document the mileage since we're already into May?
sorry?
Is it too late to document mileage?
No. Honestly, what I do sometimes when I forget how to do my mileage sometimes too. And then what I do is I go and I look at my Outlook calendar and I sit there and say, okay, that client I went to that day, and I was like, okay, I started out from my office, I went there and I write it down, I incorporate it. And I even one time I went back and, because even if you go to like Office Depot or OfficeMap or Costco to pick up supplies for the business, that's deductible too. Okay, so you can always go back and regenerate it if you have your schedule and you know what you did those days. Yes. Go ahead.
On here you have meals and entertainment, and then it has different percentages. Could you give me an example of what makes one different percentage versus the other?
One is if it's out of town, it's a different percentage. If it's like when we go to the picnic today, that can be considered like 100% because it's not an entertainment. It's an actual. It can be considered kind of like as office supplies in a way, you know. Or if you have an office full of employees and you keep the refrigerator stocked with snacks for them. Now, if you're a one-person office and you keep your refrigerators snack, that's one of those borderline expenses that you're going to be, But if you have, a lot of employees and you do that, that is considered, more than just 50%. Oscar.
Any software you recommend for helping keep track of this?
Of course, I like QuickBooks just because it's the easiest thing that's out there, even for you guys. It's easier to work through and understand. Whereas with PeachTree, you really have to know what you're doing with PeachTree to actually do what it is that you need to do. But there's a lot of softwares out there. The Neat Desktop, they have where when you scan the stuff in, you can actually have your expenses categorized, and you can print a report out through that as well. So that I think might be the easiest thing if you can figure out how to work it. But it's a little pricey as well.
Those scanners that scan your receipts, do you throw your receipts away once you scan them, or should you keep them in a box?
I would throw them away, honestly, just as long as you back up. If you back them up to a flash drive, back them up to a hard drive, off-site backup. Because really, technology is great, but then at the same time, if you get a virus and wipe all that out, you're going to have to resort back to paperwork. And so unless you're really good at backing up and you really make sure that everything is backed up multiple places, multiple times, then I would throw away those receipts unless you know for sure.
So if you're scanning a receipt, you make sure that you write on that receipt, or can you write on the scanned piece of paper next to that receipt what you did or who you were talking to?
I would write on the receipt before I scan it. That
Okay.
way, when it gets scanned, the writing and everything is already scanned into it. And then when if you write something on a receipt and then 3 years from now you get audited and the auditor sees that, you're actually writing on the receipt, that gives you points with the auditor because you are actually taking the time to make sure that, you're writing on the receipts and stuff like that. You're not going to do that if you're, but I guess you can if you're trying to defraud too, but generally, not.
Is it okay to write on the back of the receipt? Sometimes
Yes.
there's none on the
Yes.
front.
Yes.
And if you don't have the Neat Desk thing, I know there's some places that use that thermal heat, and those receipts will be blank
Yeah.
after a certain amount of time. So it's,
Yeah.
if you get familiar with a certain place that uses that type, it's good to copy those receipts.
Yeah.
Because I saved them before for stuff, and then I went back and it was blank pieces of paper.
Yeah.
You know.
But if you have them set up where it's attached to the bank statement, because that receipt is going to show up somewhere, whether it's on the bank statement or a credit card statement, unless you pay cash for it. But it's going to show up. And so if you have it attached to the bank statement or credit card statement, you're getting audited, and they flip through and it's blank, they're gonna know. And then they'll just go by what's on the bank statement. Any other questions? Going once? Go twice?
Thank you very much. Thank you. Really informative.